The Dow falls 800 points in a single session. On the surface, that sounds like the story. Screens flash red. Anchors speak in urgent tones. Analysts debate whether this is the start of a correction or just another volatile day. But the number is not the story. An 800-point drop is a reaction. It is a visible tremor. What matters is the pressure building beneath the surface, because at the same time, stocks were sliding. Something far more important was happening quietly in the background. Nearly $2 trillion in bank liquidity was no longer flowing the way it had been. Liquidity is not a headline word. It does not trend on social media. But it is the oxygen of the financial system. When liquidity is abundant, banks lend freely, markets absorb shocks, companies refinance debt without stress, governments roll over deficits without drama. When liquidity tightens, everything changes. The stock market can fall for many reasons: earnings fears, geopolitical tensions, technical selling. But when liquidity contracts, markets fall for a different reason. They fall because the system itself is pulling back. Imagine the financial system as a network of pipes carrying capital instead of water. For years, those pipes have been wide open. Central banks injected reserves, deposit levels surged, credit expanded, even weak borrowers found funding. Now picture those pipes narrowing. The Dow's 800-point drop is not just investors feeling nervous. It may be the first visible sign that the flow through those pipes is slowing. And when financial plumbing tightens, pressure builds in places most people are not watching. Where did the $2 trillion go? That is the first real question. Did deposits quietly leave smaller banks and move into money market funds? Did higher interest rates make holding cash inside traditional banks less attractive? Did institutions begin parking funds in short-term government securities instead of lending into the private economy? Each of these shifts matters because liquidity is not static. It moves, it concentrates, it hides in balance sheets. When liquidity drains from banks, it does not disappear into thin air. It relocates, and the difference between liquidity sitting inside the banking system and liquidity parked in safe instruments is the difference between expansion and contraction. This is why today feels different. Markets have experienced volatility before. We have seen sudden drops during rate hikes. We have seen geopolitical shocks. But a large, rapid decline paired with a measurable contraction in available bank liquidity suggests something more structural. It suggests trust is thinning at the margins. Banks operate on confidence. Depositors assume funds are available. Businesses assume credit lines will roll over. Investors assume counterparties will meet obligations. Most of the time, those assumptions hold because liquidity is plentiful. When liquidity shrinks, confidence becomes more selective. Large institutions with strong balance sheets continue operating smoothly. But weaker links in the chain begin to feel strain. Funding costs creep higher. Lending standards tighten. Risk appetite narrows. The stock market often senses this shift before the broader public does. Equity prices respond not just to earnings, but to credit conditions. When access to capital tightens, valuations compress. So the 800-point drop is not random noise. It is a signal flare, not a signal of collapse. Not a declaration of crisis, but a signal that the system may be entering a different phase, one where money is no longer effortless. The deeper issue is not whether the Dow recovers tomorrow. The deeper issue is whether this liquidity contraction is temporary or the beginning of a broader repricing of risk across the financial system. Because if $2 trillion in liquidity has quietly stepped back, then someone, somewhere, is adjusting their behavior. And that raises the next critical question. What exactly changed to cause this shift? And why does it suggest the rules of the market may no longer apply in the way investors expect? To understand what may have changed, we need to slow down and define the word that keeps surfacing: liquidity. Liquidity is not just cash in a vault. It is the ability of the financial system to function smoothly. It is the capacity of banks to make loans, settle payments, meet withdrawals, and finance markets without friction. When liquidity is strong, transactions clear easily, credit flows, risk feels manageable. When liquidity weakens, the system becomes fragile. At its core, liquidity depends on confidence and balance sheets. Banks hold deposits. Against those deposits, they extend loans and purchase securities. As long as deposits remain stable and asset values hold steady, the machine runs quietly in the background. But over the past year, several forces have been moving at the same time. Interest rates have risen sharply. Higher yields make short-term government securities more attractive than traditional bank deposits. Money has flowed into money market funds seeking better returns. That shift may seem small on the surface, but when scaled across trillions of dollars, it changes the funding base of the banking system. At the same time, emergency lending facilities introduced during previous stress periods have begun to shrink. Temporary support programs are not permanent. As they roll off, banks must rely more heavily on private funding markets. That funding is often more expensive and less predictable than there is the bond market. Banks hold large portfolios of government bonds and mortgage-backed securities. When interest rates rise, the market value of those bonds falls. If banks are forced to sell assets to meet withdrawals or rebalance liquidity, they may realize losses. Even unrealized losses can limit flexibility because regulators and investors watch capital levels closely. This combination matters. Deposits shifting, support programs fading, bond prices under pressure. Individually, each factor can be managed. Together, they compress the system. When liquidity contracts quickly, markets begin to behave differently. Investors notice subtle changes before dramatic headlines appear. Assets that once moved independently begin to fall together. Safe instruments experience unusual volatility. Credit spreads widen as lenders demand higher compensation for risk. These are not emotional reactions. They are mechanical adjustments. For years, abundant liquidity suppressed volatility. It flattened risk premiums. It encouraged leverage. Corporations refinanced debt at low rates. Investors bought longer duration assets, confident that funding would remain accessible. But tighter liquidity reverses that logic. If refinancing becomes more expensive, companies delay expansion. If short-term funding costs rise, leveraged trades unwind. If banks tighten lending standards, marginal borrowers struggle first. Markets begin repricing not just earnings expectations, but balance sheet resilience. History shows that rapid liquidity contractions often precede larger credit events, not because contraction guarantees collapse, but because it exposes weak structures that were sustainable only under easier conditions. Think back to prior tightening cycles. The pattern tends to repeat. Liquidity shrinks. Volatility increases. A weak institution or sector surfaces. Policymakers respond. Stability returns, but only after stress reveals hidden vulnerabilities. The key insight is this. Markets do not break when liquidity is abundant. They break when it is withdrawn. That is why an 800-point decline paired with a measurable drop in bank liquidity is not simply a coincidence. It is a signal that the system may be recalibrating after years of extraordinary support. This recalibration does not happen evenly. Large global banks with diversified funding sources may adapt more easily. Smaller institutions, dependent on concentrated deposit bases, face greater strain. Hedge funds relying on short-term financing feel changes immediately. Corporations rolling over debt in the next 12 months watch yields closely. And as these pressures build, correlations that investors relied upon can fracture. Government bonds may not provide the same hedge if inflation remains sticky. Equities may struggle even when economic data appears stable. Traditional defensive positioning becomes less predictable. In other words, the rules that worked during the era of easy money begin to break. The Dow's drop becomes less about sentiment and more about structural adjustment. Liquidity is being repriced. Risk is being reassessed. The cost of capital is rising. But financial markets are only one layer of the system. Because when liquidity tightens at this scale, it does not stay confined to trading desks and bank balance sheets. It moves outward into supply chains, corporate strategy, and geopolitical leverage. And that is where the real battle begins. When liquidity tightens, the impact does not stop at trading screens. It moves outward into the real economy, into the places where goods are produced, shipped, financed, and sold. Markets may react first, but supply chains feel the pressure next. Banks sit at the center of this system. They issue letters of credit that allow shipments to move across oceans. They provide working capital so manufacturers can buy raw materials before receiving payment. They extend revolving credit lines that keep inventory flowing through warehouses and onto store shelves. When liquidity is abundant, these functions operate quietly. Credit is approved, payments settle, expansion plans move forward. When liquidity tightens, banks become selective, lending standards rise, risk departments grow cautious, margins increase. What once was automatic becomes conditional. A mid-sized manufacturer that relied on rolling short-term debt every 6 months may suddenly face higher rates or stricter terms. A regional distributor may find its credit line reduced. This is where the real battle begins. Large global institutions often have access to multiple funding channels. They can tap bond markets, draw on central bank facilities, or shift capital internally across divisions and countries. They have diversified deposit bases and sophisticated treasury operations. Smaller regional banks do not. They depend more heavily on local deposits and wholesale funding markets. If deposits move toward higher-yielding alternatives, their funding base shrinks. If wholesale markets demand higher rates, costs rise quickly. That pressure is passed through to borrowers. Mid-sized businesses, in turn, have fewer options than multinational corporations. They cannot issue bonds easily. They cannot access global capital pools. They rely on relationship banking. In a tightening cycle, relationships matter less than balance sheets. The shift is subtle at first. Loan approvals take longer. Covenants become stricter. Renewal terms become less generous. Companies that expanded aggressively during the era of low rates begin to reassess hiring and investment. This is how liquidity transmits into the real economy. Governments face a parallel challenge. Many advanced economies are running large fiscal deficits. Financing those deficits requires steady demand for sovereign bonds. When private liquidity is strong, that demand is easier to sustain. When liquidity contracts, competition for capital increases. Higher government borrowing needs can crowd out private investment. Yields rise. Refinancing costs grow. The burden compounds. Now add the global dimension. Capital does not remain confined within national borders. It moves toward safety, yield, and stability. When financial conditions tighten in one region, capital can flow to another. Stronger economies with reserve currencies may absorb stress. Emerging markets with dollar-denominated debt may transmit it. This is not just a market story. It is a power story. Who controls funding channels? Who has access to central bank swap lines? Which institutions can borrow at scale during stress? These questions determine which parts of the system bend and which parts break. Headlines focus on the Dow because it is visible. But the deeper battle is being fought in refinancing schedules, treasury departments, and credit committees. A corporation with billions in debt maturing next year is watching yields carefully. A private equity firm dependent on leverage is recalculating returns. A regional bank is monitoring deposit flows daily. Each actor is adjusting behavior in response to tighter liquidity. Over time, these adjustments compound. Slower credit growth leads to slower investment. Slower investment leads to slower output. Slower output affects employment and wages. None of this happens overnight. It unfolds gradually, often quietly, but the structure of power becomes clearer during these periods. Institutions with diversified funding survive more easily. Economies with strong currency demand maintain flexibility. Those dependent on external capital face sharper constraints. The Dow's drop was a visible signal. The liquidity contraction was the structural shift. But the real contest is about who can secure funding in a world where money is no longer effortless. And once funding becomes selective, the next layer of pressure emerges, not just on companies and banks, but on currencies themselves. Because when capital becomes scarce, the value of money changes. Because when capital becomes scarce, the value of money itself begins to shift. Liquidity contraction does more than pressure banks and corporations. It reshapes currency dynamics. Money is not just a medium of exchange. It is a claim on future production. When credit expands, that claim grows. When credit contracts, the system must reconcile promises with capacity. Start with the basic mechanism. When banks pull back on lending, fewer loans are created. Since most modern money is generated through bank lending, slower credit growth means slower money creation. Over time, that can reduce inflationary pressure because demand cools and spending moderates. But the path is rarely smooth. A sharp slowdown in credit can expose imbalances built during expansion. Highly leveraged sectors feel strain first. Asset prices adjust. If the adjustment is orderly, inflation gradually declines and stability returns. If it is abrupt, instability can surface before inflation fully subsides. At the same time, governments remain large borrowers. Public debt levels across advanced economies are historically elevated. Servicing that debt depends on steady demand for sovereign bonds. During periods of abundant liquidity, private investors, banks, pension funds, and foreign institutions absorb new issuance without much disruption. When liquidity shrinks, absorption becomes harder. Higher yields may be required to attract buyers. Rising yields increase interest costs. Higher interest costs expand deficits further. This feedback loop can tighten financial conditions even more. Now consider the currency layer. The US dollar sits at the center of the global financial system. It dominates trade, settlement, commodity pricing, and reserve holdings. In times of stress, global capital often flows toward dollar-denominated assets, seeking safety and liquidity. This can create a paradox. Domestic liquidity may tighten, yet the currency strengthens because global demand rises. A stronger dollar eases imported inflation but increases pressure on countries with dollar-denominated debt. Emerging markets that borrowed in dollars must repay with more expensive local currency. Liquidity stress in one region can ripple outward to exchange rates. Over time, reserve managers and sovereign wealth funds assess risk differently. If confidence in financial assets wavers, whether due to fiscal sustainability concerns or persistent volatility, diversification becomes more attractive. This is where hard assets enter the discussion. Gold, for example, does not rely on a counterparty's promise to pay. It does not carry credit risk in the traditional sense. Throughout history, periods of monetary uncertainty or fiscal strain have coincided with increased interest in tangible stores of value, not because collapse was certain, but because balance sheet strength mattered more. The shift is rarely dramatic at first. It appears in incremental reserve reallocations, in steady central bank purchases, in gradual changes in asset preference among institutional investors. Liquidity stress changes incentives. When money is easy, yield dominates decision-making. Investors extend duration. They accept lower spreads. They prioritize return over resilience. When liquidity tightens, resilience rises in importance. Shorter duration becomes attractive. Counterparty exposure is scrutinized. Sovereign balance sheets are compared more critically. This is how tightening liquidity connects to currency pressure and asset rotation. It is not driven by fear alone. It is driven by arithmetic. Higher yields increase government interest burdens. Slower growth reduces tax revenue. Larger deficits require more issuance. More issuance tests demand. Demand influences currency valuation. The system becomes more sensitive. Even inflation dynamics respond in complex ways. A strong currency can suppress imported price pressures, but if fiscal stress leads to policy intervention or renewed monetary expansion, inflation expectations may resurface later. Liquidity contraction, therefore, does not simply reduce inflation or strengthen money. It introduces volatility into the rules governing both, and as these pressures build at the macro level, they eventually filter down to households and businesses in direct, practical ways. Because changes in currency, strength, credit availability, and government financing do not remain abstract, they shape mortgage rates, job security, retirement accounts, and the cost of everyday goods, which brings the focus back from global flows to personal reality and to the mental models needed to navigate it. Which brings the focus back from global flows to personal reality and to the mental models needed to navigate it. When liquidity tightens, The first effects appear in financial markets, but the consequences do not stay there. They move slowly into daily life. For households, a liquidity drain often shows up as tighter credit conditions. Mortgage rates remain elevated. Auto loans become more expensive. Credit card limits stop expanding. Banks apply stricter underwriting standards. Approval processes lengthen. None of this feels dramatic at first. It feels incremental. A family looking to refinance discovers the monthly payment no longer improves. A small business owner renewing a credit line faces higher interest costs. A recent graduate notices fewer job postings in interest rate-sensitive sectors like construction or technology. Liquidity tightening is rarely loud. It is restrictive. Higher borrowing costs change behavior. Consumers delay major purchases. Businesses postpone expansion plans. Hiring slows. Over time, wage growth moderates as companies guard cash flow. Retirement accounts reflect this shift as well. Equity markets become more volatile. Bond prices fluctuate with interest rate expectations. Diversification does not always provide the same stability it once did, especially if correlations change during stress periods. This is why understanding the structure matters more than reacting to a single headline. 3 simple mental models help clarify what is happening. First, liquidity is financial oxygen. When oxygen is plentiful, activity expands naturally. Growth feels easy. Risk-taking increases. When oxygen thins, movement slows, not because participants panic, but because the environment demands caution. Second, banks are transmission channels, not vaults of endless cash. Many people assume banks simply hold money safely until it is withdrawn. In reality, banks transform deposits into loans and investments. They connect savers to borrowers. When deposits decline or funding becomes expensive, that transmission weakens. The impact is not immediate collapse. It is reduced velocity. Third, when credit slows, asset prices adjust before employment does. Markets respond quickly because investors price future expectations. Companies, however, adjust staffing and production gradually. This lag can create confusion. Stock indices may fall even while unemployment remains low. Observers may conclude the market is overreacting, but often markets are anticipating tighter conditions months ahead. Thinking in systems rather than headlines changes interpretation. An 800-point drop in the Dow becomes less about daily sentiment and more about a shift in financial oxygen levels. Rising loan rates are not random. They reflect balance sheet constraints. Slower hiring in certain sectors is not isolated. It is connected to capital costs. This perspective reduces emotional reaction. It encourages questions instead of conclusions. Is credit growth accelerating or decelerating? Are banks expanding balance sheets or contracting them? Are government deficits increasing at a time when private liquidity is shrinking? These structural questions matter more than daily volatility. For households, practical implications follow logically. Maintaining flexibility becomes valuable. Fixed expenses matter more when income growth slows. Debt structures deserve attention when rates are elevated. Diversification is not just about returns, but resilience. None of this requires alarm. It requires awareness. Liquidity cycles have occurred many times before. Expansion, contraction, adjustment. The pattern repeats, though the details change. The goal is not to predict precise turning points, but to recognize the phase. Right now, the signs suggest the system is adjusting to tighter conditions after years of ease. The key question becomes, how far does this adjustment go? Does it stabilize into a controlled slowdown? Does a weak link surface and force intervention? Or does policy shift once again to expand liquidity and restart the cycle? Those possibilities define the road ahead. At this stage, it is not about predicting a single outcome. It is about understanding the range of plausible paths and the signals that would point toward each one. The first path is a controlled slowdown. In this scenario, central banks recognize tightening conditions early and act carefully to stabilize funding markets. They may adjust liquidity facilities, fine-tune balance sheet reductions, or signal flexibility in policy. Volatility remains elevated for a period, but systemic stress does not spiral. Credit growth slows, but it does not freeze. Economic activity moderates. Inflation gradually cools. Asset prices reset to reflect higher capital costs. Yet the broader system holds together. This outcome would feel uncomfortable, but manageable. Growth would be slower than many expect. Corporate earnings would face pressure. Government deficits would remain a challenge, but funding markets would continue functioning. The key feature of a controlled slowdown is containment. Stress appears, but it does not cascade. The second path is a credit event. Liquidity contractions often expose weak links. A regional bank overly dependent on concentrated deposits. A heavily leveraged fund misaligned with funding costs. A corporate borrower unable to refinance at sustainable rates. If one of these entities fails abruptly, confidence can shift quickly. Counterparties reassess risk. Funding spreads widen. Liquidity tightens further as participants step back. In a credit event scenario, contagion becomes the central risk. Not because every institution is unsound, but because uncertainty spreads faster than information. Markets reprice aggressively until clarity returns. Policymakers may respond with emergency measures, but the damage to confidence can take time to repair. Asset prices could adjust more sharply. Lending standards could tighten further. Economic contraction would become more likely. The defining characteristic here is amplification. Stress feeds on itself. The third path is a policy pivot. If tightening conditions threaten financial stability or employment significantly, authorities could choose to reintroduce liquidity aggressively. Balance sheet expansion might resume. Rate cuts could arrive sooner than expected. Emergency facilities could expand. Such a pivot would likely calm markets in the short term. Asset prices could rebound. Credit spreads could narrow. But second-order effects matter. Reintroducing liquidity while inflation pressures remain unresolved risks, reigniting price instability. Currency dynamics could shift. Long-term interest rates might not fall as expected if investors question fiscal sustainability. A policy pivot solves one problem while potentially reviving another. These three paths are not mutually exclusive over time. The system could begin with a controlled slowdown, experience a contained credit event, and then see a partial policy pivot. Economic cycles rarely follow clean lines. The deeper question is this: was the 800-point drop simply a warning shot, a momentary signal that conditions are tightening, or the beginning of a broader repricing of risk across credit, currencies, and sovereign balance sheets? The answer will not emerge from headlines alone. It will appear first in liquidity indicators, in bank lending surveys, in deposit flows, in credit spreads and funding markets. These measures tend to shift weeks before stock indices fully reflect the change. Understanding those indicators is essential because they reveal whether the system is stabilizing or straining beneath the surface. In the next discussion, we will examine the specific liquidity gauges that matter most right now, and why they often tell the real story long before the Dow makes its next dramatic move.